Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, October 24th, 2018. Members of the site, not a lot to report. For members of Right Side of the Chart, I did a video this morning covering the broad markets, everything to look at, crude oil, treasury bonds, gold, other things that we're trading on the site, and doing well. We're firing on all cylinders right now, using asset allocation, diversified portfolio, leaning towards obviously the short side on equities. But let's just recap what happened in the market for everybody today. So starting out this morning, once again, so watch, rinse, repeat. Here's that trend line that I've been highlighting recently, really living in the world of this 15-minute chart for the most part. So we had a pop up to that trend line today, which once again offered us an objective short entry, or was that, yeah, that was late yesterday. Yeah, that was yesterday, just before the close. That's right. We ran into that with the big rally yesterday, the big turnaround reversal to the button there. I had that 174 intersecting resistance and the trend line. So there was, again, your objective shorting entry. I pointed out 172.63 is an objective level when we came up. And I said if we went through that yesterday, that would be your next objective short. And that's it. So you have to take these opportunities during a downtrend. If the outlook remains bearish, which it has, you have to short the rips, and if you're active trader, cover the on the dips back to support. But again, you need to define your swing, your trading style, I should say. Trading room, I get just a ton of questions. It's too late to short or add to SQQ or QQQ. If you're in it, you can add, continue as the case builds for a trade. That's old trading 101. A lot of the professionals, they don't average down on a losing position. They'll only average in on a winning position. So everything we saw today was a trend day. We had that reversal. The markets moved lower. And then highlighted earlier, we had this level here. And you know what? Actually, this is what I highlighted this morning on the site. The 5-minute downtrend lines and these levels here. So we took out 171.45. That was a little minor resistance level there. Support, I should say, resistance yesterday, popped above it, came up, took it out today, came in for a back test, and that was really, for the most part, as far as at least the way I see things, the last objective short entry or add-on today on that kickback after we broke that level. You can see how it's defined. It's a big gap. Gaps are natural support and resistance levels, just like the top of that gap stopped the advance. And then that bottom of the gap has acted as support and resistance. And so that's it. So nice downtrend or trend day today, I should say. And I want to speak to that real quick too, because there are some takeaways from this market. And this is what I said in the trading room today on right side of the chart, is that this is typical severe correction and or bear market action. What I mean by that, well, during the beginning of a downtrend, especially, beginning of a bear market or just a correction that has a lot of meat left on the bone, you have the dip buyers that come in and usually buy the dip. So the first thing that happens, I talk about these WTF, moments and point of recognition. That I think we probably saw that a little bit. Well, we did see some of that today. We saw it a few weeks ago during that big slide that we had towards the end of that last leg down. Then we had the counter trend bounce. This is what I wanted to talk about here. The Qs, if you recall last, what was the date? It was on Tuesday, the 16th. We had about it doesn't look like much here because we've had such big swings in the market, but this move there, if we take everything away from right here, there's where we closed on that Monday, and then Tuesday we had that big rally, over, about a 3% rally on QQQ, very strong day. And, just from comments on the site and hearing everything else, I mean, the bulls were beside themselves. But again, it didn't do anything technically. It's just part of the norm, the volatility. Now, what did happen since then? There's certainly, I'll have to admit, there was certainly the potential they could have built on those gains and turned it into something more. But what happened in reality here, or at least looking back in hindsight now, that gain and then some was faded. So what that is, that's a knife through the heart of the bulls. It is a morale killer. It is a stop clearer. Longs that stepped in to buy there, to buy the dip that thought everything was over, that hurts. Okay, so that's number one. So then what happened yesterday? You remember we woke up, big gap down. This is it right here. From there to there, futures were down overnight, and we were down big in the morning. I forget how much, but here we can quantify it here by dragging using the measuring tool. Pops up to the left. what is that, about a 3% drop or so to the lows. But then we turned around and mounted what seemed like a very, and it was an impressive rally. You can't take anything from that. Almost a 3% recovery off the lows to almost go flat. But as I said in yesterday's closing market wrap, all the indexes still closed red. They were still below resistance. In fact, that was simply a kickback rally to resistance. And so now where I'm getting at here is I know that charged up a lot of bulls yesterday to see that recovery. And sure, if the bulls could have built on it, great. But again, this is typical bear market action. Boom, that is a knife through the heart of bulls to longs. And this is what happens during the early stages of a correction. You get dip buyers stepping in. And finally, at this point, and we may have now had that, what I call the WTF or POR, point of recognition moment, where they realize, wait a minute, something's wrong here. This has worked for years. I've been doing this, and Kramer told me to buy the dips or whatever it is. It's not working anymore. And that's where you have a couple things happen. You have people start to throw in the towel, say, okay, well, I need to cut my losses. I'm underwater. I bought dips, or people that have been in this market for a long time, and we're letting it run, which is a prudent thing to do during an uptrend. If you're not following technicals, these sell signals should have got you out. But so stops are starting to be hit on longs. Dip buyers are going to, at some point here, probably stop stepping in and buying these dips because they see it's no longer working. And then the bigger part here is the unwinding of the margin bubble. Again, you can Google the charts on it, but when you go back over time, historically towards the end of a bull market, and I can tell you this time around, margin interest is at extreme highs. And by the way, that's not short sellers. At the end of a bull market, and at any point in time in the market, there's always a lot more longs in the market than shorts. Shorts make up a very, very small piece of the pie, especially in the broad market. There might be a single stock like Tesla with high short interest, but in the market, so when you have that extreme margin, um, the unwinding of that is going to go one direction. The unwinding of the margin bubble does not go up at the end of a bull market; it goes down. So we'll see. We're still not in bear market territory yet, but when I look at the charts, let me find a clean board for you. Here's a story. You have to just look at the charts and trade them for what they are. Big move down, which was the initial leg. Like I said, that's usually not how a sharp correction ends. Flag there for a little bit, broke down, and nothing but impulsive selling so far. I'm going to give the bulls a little bit here to chew on. That's what I do. I point out what I see, and you guys then decide what to trade. Let's go to a 60-minute chart of QQQ. Yesterday, I mentioned in the videos in the wrap up that we had positive divergence on all the 60-minute charts of every major index tracking ETF. That would be SPY, the S&P 500, a DIA, the Dow, which I don't really trade much, but a lot of people track the Dow, MDY, the mid-cap ETF, and IWM, but we didn't have it in a QQQ. We now have potential divergence. So there, if we can turn around and rally the market, there's support levels all the way down. That's the thing about a bull market. When you're at new all-time highs, there you don't have any resistance levels overhead. But when the market's coming down, and that's another reason I love trading corrections and bear markets, it's tougher to trade all-time highs, easier to trade on the way down because you have price history, you have support levels that are well defined. Well, right now it looks to me like this one was smashed through. I know I have a lot of lines on this chart, but 169.60, the recent lows, they were taken out. That was a pretty decent support. That opens up the door for my target zones. Members of the site have the exact targets for the QQQ short trade. But that's all it looks like to me, and anything can happen. But there it is. You have the initial leg down, flagging action, impulsive move coming out of the flag. The indicators, the momentum indicators, are still pointing lower. I pointed that out the other day. There was a little time during the flagging action that they started to turn up, but there was a rejection. So right now, everything's pointing down. That 60-minute divergence that I highlighted for you a second ago is only potential divergence. In my book, you need to have a bullish crossover on the PPO, which we do not have yet. PPO is still pointing lower. Maybe we get it soon, and maybe not. So SPY, here's what happened yesterday. We had the divergent low, and this is another signature of a bear market or severe correction. And when you have bullish chart patterns, I've been going long this bull market on just about every 60-minute divergent low for years, covering shorts on pullbacks on those. That's my favorite swing trading time frame to position for at least a few weeks. And I didn't do it yesterday because I was suspicious, even though we had all of the indexes but QQQ. Again, my long-term analysis, the long-term weekly charts, daily, told me don't trust it. Just like you can't trust bearish patterns as much in a strong uptrend. Uh, this just shows me the market is what I think it is right now, if that makes any sense to you, because these clean looking divergent lows at double test of the recent lows. Remember, SPY yesterday had successfully tested that recent low. It undercut it a little bit, but QQQ reversed just above it, which is sometimes what you do. So again, by all accounts, the bulls could have took it and ran yesterday with it, but they didn't. And I'm sure a lot saw that. And like I said, I can make a bearish or bullish argument at just about any point in time. But my job is to act on one. Paralysis by analysis. If you sit there and second guess and you say, well, I could go long because of this, but I could short for this, and you don't know what to do, stay out of the market. But the uh, the money is made by acting, and this so far this didn't play out, so that's a foiled potential bullish setup. You can see the indicators are pointing lower. Hey, this can turn around tomorrow. There's still potential divergence here. They could rally this market up strong if they erase today's losses. That's a big recovery to make. It's 3% in SPY, QQQ 4.5% drop. Anything is possible. And if they do, well, that's certainly bearish. But again, the same thing I've been saying. The markets have a mountain of overhead supply to contend with. And, these trend lines, I'll color this now a different color for you. There's a downtrend line and a lot of overhead resistance levels. So that's that. As of now, I still think we're going lower. Again, I have to continue to reiterate big earnings tonight. Well, AMD was tonight. Microsoft, I'll take a look at that. I started the video. I'm looking at futures are hardly up. So if Microsoft's numbers are already out, it's probably not doing much to the futures, or maybe they didn't report yet. I'm not following that. I just wanted to get this video out to you. But here it is, guys. We're heading into today. Wednesday is over. Tomorrow is the big earnings report day. Tomorrow we have, let me click my economic calendar on another monitor here, Amazon, Snap, Alphabet, GOOGL, Intel, that's some of the bigger names. And so there is certainly hope. It's a dangerous word to use in the market, but there is hope that the Qs can rally back up and park it again on or above these long-term trend lines in the 40-week moving average. But as of now, it does not look good. I often say you want to wait for an daily or weekly close, when trading off the weekly charts. Anything's possible, but it looks to me at best now is a back test. And again, that would offer another objective short entry. If we bounced back tested this trend line from below, with a stop somewhat above, especially on a weekly closing basis. But it's hard to really time your entries and exits off. This formulates the bigger picture for me, where we're likely headed. And so if we're going where I think we're going, and what I've been talking about is, as bad as today was, we haven't seen waterfall selling yet. This is a pretty bad down day, but we can see quite a bit more. And the good thing is, if you're long and you were trapped here, I think I can make no promises, but I think it'll be over rather quickly. I think we'll hit my downside targets in the next week or so here, and then be looked to position long for some bounces. There should be some nice setups. A lot of my trades should be coming to support. Speaking of that, on the site, our Netflix short hit our first price target today. Our what was it? Nvidia hit our second price target. So a lot of our trades are popping, our short trades. I mean, these are quick gains, double-digit gains in just short order. And but I do think there's still some little more downside here, and we'll have to see what tomorrow brings. Again, Amazon, Alphabet, and Intel, the three of those together do have the potential to turn things around. We'll just have to see how the market reacts to them. At this point in time, there's a lot of technical damage. And the theory that I've had recently, and I've shared with you, is one of institutions unwinding the risk trade. They have to. CalPERS, the California Pension Retirement Fund, these big pension plans, mutual funds, they have to reduce risk. They cannot sit through a sell-off like this, especially now, because this isn't working for them. This trade, TLT. Now, I can't get into specifics because we have an active trade on this on the site right now, but this is usually the king of flight to safety instruments, and that's where, the old 60/40 asset allocation model, it's been around forever. Most professional funds, institutions to hedge risk have, carry roughly 60% equity allocation, 40% bonds, because what happens, they tend to zig and zag. When stocks go down, bonds go up. That's been the historic relationship. We haven't seen it yet. So this is crushing pension plans, hedge funds, and they have to get their risk in line here. If treasuries don't catch a bid soon, gold isn't really doing much. It's gone up, and we have also an active trade on that, so I'm not going to talk about that as far as price targets go. But these, this is going to hurt the markets, and this is where you can get a real fast unwinding of long side positions, because as I've been saying for a long time, and I know I'm not the only one, too many people are crammed into these stocks, these FANG stocks. Apple, Amazon, Microsoft, Google, they make up, almost the top five components alone, and QQQ make up almost half the returns. That's insane. And it's going to go the other way. It's worked one way so far. When money flows in, everything's going good. But all right, I don't want to warn of doom and gloom. And like I said, I only see a little more downside here from, where we are. And a little, relatively speaking, I think we're past the halfway point down in the initial leg down. And like I said, well, I can't tell anybody what to do, but I think, if things continue to play out the way I think they will, we're now in that second impulsive wave of selling. So it could happen pretty quick, and then we'll be looking to close out a lot of shorts and go long for a bounce soon. It's as simple as that. If that doesn't work out, like I say, my analysis and the markets are dynamic, and so is my analysis. So if something changes, I'm watching those 60-minute divergences. I'll watch for reversals, certain cues in the market that might tell me, hey, maybe this is over. Maybe we're not going to go down as far as I think. And then we'll look to cover shorts, reduce some short exposure or go long. And I'll just hit on SPY before I wrap this video up. So same story. I really don't want to beat a dead horse here. There's the recent consolidation area. Your impulsive move broke down, and as usual, the more you go down, the more stops are hit, the more you reach that WTF moment, point of recognition, where what's going on here? This is not what should have happened. The SPY should have held here at 279.26. It should have held here. We should have rallied after this, and we didn't. So that's where you start to see capitulation, stops being hit, dip buyers stop buying for a while, the shorts come in and play, and shorting will bring the market down. And that's, again, the beautiful part of corrections are that they're very swift. You can make a lot more money in very short order. You can make in just days or weeks what took months, sometimes years to make on the upside. But you got to be quick. And the final thing, I'll leave it at this before we go to the 15-minute chart. You cannot stay too late to the short party. That's one thing I've learned. Better to cover those shorts early. I get a lot of questions on the site. Look, if you're short now, trail it down, use some wide stops. Here's all the levels that we quote unquote shouldn't violate on a bounce up. But trail your stops down, and better to be a day early or a couple percentage points early in covering your shorts than late, because once it stops, the reversal usually comes very fast. Sometimes you get a double bottom, a second test of the lows. Sometimes when the market gets very stretched, you explode off there when the shorts begin to cover and the longs realize, okay, we've had a correction, brought stock prices back down to where they should be. Valuations are good, everybody piles in. So just be ready for that. We don't have to have an explosive move once this correction ends. Like I said, we could pound about, bottom out, maybe double test it, but we could also fire off. So I just want to throw that out there. And the most important thing is have a trading plan. Don't wake up every day and react to what this market's doing. Because if you're doing that, if you're getting bullish yesterday on yesterday's rally, and then you're getting bearish on today's dip, that's been the trend lately. Up big one day, down big the next. But the overall trend, and this is what keeps me, bearish, the overall trend, oops, sorry, wrong line, is down, bearish. Despite these zigs and zags, this is what we're doing, and that's a downtrend. So you got to trade it as such, and that means shorting into resistance until there's significant evidence shorting into bounce backs, I should say, to resistance until there's sufficient evidence that the downtrend is either likely over or close to being over. Same chart I showed you. I showed it on QQQ a minute ago, and this is where I wanted to wrap up. There's your downtrend line on SPY. Again, I pointed that out this morning on the video for members that we hit that, rallied up to that level. And I think I did it in yesterday's video. Yeah, you all got that, I believe, yesterday on the YouTube channel. Rallied right up to that intersecting resistance, downtrend line and price resistance, top of that gap right there. And it was an objective shorting entry. And then again today, we took out the recent lows and boom, that's where we had a second leg down. So there were plenty of ops to get short today, and that's what happened. So we'll watch everything. We'll see how the earnings go. I don't think there's any. It doesn't look like any action in the futures or QQQ after hours right now. So like I said, tomorrow's a big earnings day, and maybe the market goes into a holding pattern again. Maybe not. I don't know, because it all has to do with unwinding. If we start to see margin calls tomorrow. If the market goes even lower, we could have another sharp leg down, but I'm guessing tomorrow probably hold up, consolidate somewhere in there. And when I say consolidate, remember the new norm now is intraday ranges of 2 and 3% or more. So consolidation could mean we could bounce up and down that much, but I think everything will kind of go on hold until Amazon, Alphabet, and Intel report tomorrow night. So take it for what it's worth, and I guess that means that you may not want to add to shorts or take a new short position if you haven't done so already. But again, it's hard for me to say because right now we're in what I call technical no man's land, which is smack in between support and resistance. And I like to short either bounce backs to resistance or short a break of support, but I don't like to short in the middle in between because you get a kickback rally and then instantly you're underwater. All right, we will wrap it up here. This has been Randy Finney with Right Side of the Chart, and we'll see what tomorrow brings. Good luck to everybody.